Last night, the three major U.S. stock index futures closed virtually unchanged, with the Nasdaq futures settling at 28,773 points, the S&P futures at 7,497 points, and the Dow futures at 52,375 points, all showing 0% change amid thin trading volume. Tech stocks continued their weakness, with the Nasdaq 100 ETF closing at $695.33, down 1.08%, hitting a near one-month closing low. Nvidia fell 1.53% to $202.81, Tesla dropped 2.01% to $380.84, and the Innovation ETF declined 1.61%, indicating that growth stocks and risk appetite remain under pressure. On the other hand, the Bitcoin spot ETF edged up 0.65% to $36.35, and MicroStrategy rose 2.13%, echoing an overnight rebound in the cryptocurrency market. No significant abnormal stock movements were confirmed yesterday. Now let us turn to the global macro thermometer. The 10-year U.S. Treasury yield closed at 4.54%, down 0.7% over the past 7 days. The modest decline from elevated levels suggests that the market has slightly cooled its expectations for further Federal Reserve rate hikes, but the absolute level remains in tightening territory, continuing to pressure equity valuations. The VIX Fear Index closed at 18.77, which falls within the normal to elevated range of 15 to 25. However, it is worth noting that the VIX surged 12.26% over the past 7 days, jumping sharply from 16.72, signaling that market risk aversion is heating up rapidly and approaching panic thresholds. The U.S. dollar index closed at 100.75, virtually unchanged over the past week, hovering weakly around the 100 level, which provides a breathing window for emerging market assets. But if safe haven capital inflows intensify, the dollar could be pushed higher again. WTI crude oil closed at $82.49 per barrel, up 2.77% over the past 7 days, supported by supply-side concerns in the short term. However, if risk sentiment continues to deteriorate, demand-side pressures will limit further gains. Spot gold closed at $4,012.70 per ounce, down 1.8% over the past 7 days. Gold is trading at elevated levels around the $4,000 mark but has not rallied significantly alongside the VIX spike, indicating that safe haven capital currently prefers cash and short-term treasury bonds over gold. In summary, the current global market is characterized as deep risk-off mode. The only condition for a potential easing of risk aversion is if the VIX index rapidly declines and falls below 16 within the next 2 trading sessions. Looking at the external environment for the renminbi and Chinese assets, the onshore renminbi traded at 6.7768 and the offshore rate at 6.7770, depreciating 0.27% against the U.S. dollar over the past 7 days. The currency is hovering weakly near the 6.77 level, with depreciation pressure persisting but remaining manageable. The renminbi weakness is suppressing foreign capital inflows into A shares, making it difficult for northbound capital to see large-scale net buying in the near term. On the U.S.-China front, the U.S. Commerce Department's Bureau of Industry and Security announced on July 15 an expansion of export controls on semiconductor equipment and specific AI chips to China, adding new restrictions on advanced packaging and HBM manufacturing equipment. This is weighing on sentiment for A-share semiconductor equipment and advanced packaging stocks. Meanwhile, the U.S. and China held a new round of trade talks in Geneva on July 16 and 17, focusing on electric vehicles and lithium batteries. No final agreement was reached, but both sides agreed to continue consultations. This provides a short-term marginal positive for the new energy sector, though the substantive impact remains limited. Putting it all together, A shares are likely to open lower today. The combination of weak U.S. tech stocks overnight, elevated VIX levels, and pre-weekend risk aversion will likely pressure the market. If the Shanghai Composite Index holds above the 3,800 level within the first 15 minutes of trading, that would deviate from the lower open expectation and suggest a shift toward range-bound stabilization. As for index direction, A-shares already suffered a sharp sell-off yesterday, with the Shanghai Composite plunging 3.05% to close at 3,764 points, the Chi-Next index crashing 7.14%, and the Shenzhen Component Index posting a weekly loss of 8.9%, indicating that panic has been largely released. However, given the weakness in overseas markets, the implementation of tech export controls, and pre-weekend capital hedging demand, the market is likely to extend its downward momentum today, with possible technical bounces during the session but limited reversal potential. If the Shanghai Composite Index opens with volume to reclaim 3,800 points, it could shift to low-level consolidation. For sector focus, utilities and power stocks benefit from the ongoing defensive plus high dividend yield narrative, while cybersecurity stocks could see short-term activity catalyzed by the global IT system outage event. Investors should be particularly cautious with tech stocks, especially semiconductors and AI computing, as the upgraded U.S. export controls directly impact supply chain expectations. Combined with the Chi-Next index breakdown, these sectors lack rebound momentum and should be avoided in the short term. Northbound capital is likely to see net outflows today, but if the renminbi quickly strengthens past 6.76 in early trading, it could reduce selling pressure. To conclude, the probability assessment for today stands at 15% for an up move, 40% for a sideways move, and 45% for a down move. Investors should maintain a defensive posture, focusing on utilities and cybersecurity for relative resilience, while decisively avoiding semiconductor and AI computing names. Remember, in a deep risk-off environment, capital preservation takes precedence over return chasing.